Welcome to another episode of diving into something nerdy and fun in the real estate show. Let's go. It's Will Frazier here with Craftsman Real Estate Services, and today I'm going to be digging into a very light introduction to how real estate is a hedge against inflation. And what does it mean to be a hedge? Actually, there's a lot of history to the background of the idea of hedging. And so from the financial markets, like hedging your bets would refer to you're going to go in this position. Like you're strong and long on this position, if you're familiar with that wording. But it just means like you're betting on the long success, the long range success of this thing. But then you want to hedge that position. You want to create an offsetting position of safety against your main position. So you're going to hedge your bets. But I would venture an educated guess that the idea of hedging comes from a much older historical idea of hedges. You think about the idea of a home. Man, the royalty had these castles with these big towering walls, and the walls had ramparts, and they had arrow slots so that your marksman could defend your position, and you could see them coming from miles. But we didn't. We common folk, if you didn't live inside the castle walls, and this is the next generation where the castle walls had fallen and it had crumbled, and we had more neighborhood type developments in history. A hedge was a perimeter that made it more difficult for people to come in, except for those who came welcomed through the front gate. So a hedge is it's a surrounding of safety. In financial positions, it can be something that helps you offset the exposure created by a bet. And in life, what you need to understand is that you receive a lot of amazing things from the government. So do I. Like our roads, our public school system, our firefighters, our police officers, our IMSA workers, the list can go on and on and on. And the reason we have so many taxes is because we have so many services that we ask from the government, and they step up and gladly provide. One of the things we didn't ask them to do, but nonetheless they provide, is financial wizardry. And are they good wizards or bad wizards? We don't know. But starting in about 700 BC with an empire called the Lydian Empire, governments have figured out how to use currency, how to use precious metals and some things that are going to last more than one generation as currency, and then they figured out how to dilute the mixture of those metals so that you maybe don't have the same financial exposure per coin, and then maybe you could just print more or mint more coins than you have the backing for. And the Lydians weren't the only ones to do it. The Chinese Empire, the ones that brought us paper, also figured out how to use paper as a form of currency. They introduced paper currency, and they also figured out that you could write more currency notes than you had the backing for. This is the whole idea of what happened in our country 50 years ago this year in 1971, where we left the gold standard. What that meant in reality is that prior to leaving the gold standard, it is a basic assumption that for every dollar of currency, every dollar bill that exists, floating around, that Mr. Washington represents a dollar's worth of gold in a vault somewhere, one of the many American forts and vaults. So once we left that, we broke the assumption or the promise that dollar for dollar, that the dollar was tied to the value of precious metals. So as the precious metals ebb and flow, which they don't tend to do nearly as much as the currency when everything's tied together, then the value of the dollar would ebb and flow. But when we broke that, the value of the dollar became purely fiat, which if you're not familiar with that word, then you should really hop over to the Rebel Capitalist show, where I and hopefully you will bask in so much learning that George Gammon brings us. But fiat means because I said so. So why is the dollar worth $1? Because the Gov says so. And specifically, there's the Federal Reserve, and then there's the Treasury. The Treasury is actually part of the government. The Federal Reserve is not-ish, kind of. Let's see. So all that brief drinking from a fire hose intro to bring you this. Real estate, in my opinion, and in the opinion of Jason Hardman, and in the opinion of a lot of people throughout time, is a fantastic hedge against inflation. Means inflation will happen. Why? Because just like the Lydians in 700 and something BC, our government realizes that, wow, I can print $7 trillion and sprinkle it into the economy, and it kind of works, right? Like, stocks and equities are up, real estate's up, cars are up, everything's up. What's not up? Lemonade's stock value, if you've been paying attention, because they only work on the coast. But that's neither here nor there. Everything's up. So the $7 trillion of money creation didn't do anything bad, did it? Except it does. It increased the money supply. It increased the number of dollars. So there's another George Gammon, illustration. So if I have $1, and this dollar is chasing a goods and services. So we're a real estate company. We help people buy and sell their personal homes. We help people buy and sell investment properties, and we manage properties. So let's say that our services cost $1. So we have a service, and there's $1, and we exchange that for that. But what happens when now in the economy there's $2 chasing that same good or service? So our whole economic reality was based on this balance of money supply and services and goods, that could be exchanged. But now when you introduce more money supply and there's the same level of goods or services, then you get this idea of like, well, I guess we'll charge more. I guess we'll charge $3 for our services since that's what the market seems to be willing to pay. But did our earnings just go up 300%, or did something else happen? And that something else is really important. And then a next step to this is what happens if there's more money and fewer goods and fewer services. So more money chasing fewer goods and services. That's kind of a scary and frustrating proposition. Kind of makes your money worth less, right? All right, jumping back to real estate. So let's take a look at two numbers, and these are going to be Oklahoma City specific, and I'm going to focus on just the things that we can in good faith compare between the year of our Lord 1990 and today. So let's jump in. All right, gang. Let me introduce you to the tools that I'll be introducing today, and if you're familiar with these videos, you know that I am a little bit admittedly low production value. I just want to focus on getting down and dirty with the details. So we're going to pull some data from Fred. That's the Federal Reserve Bank of St. Louis specifically. And I'll link to this suggested citation in the video. But this shows us our historic sale or property values, or sale values you would presume, broken down by the quarter throughout history, going back to 1977. I think they actually go back to 1971 specifically, which is ironic, isn't it? Left the gold standard then. All right, and then we've got broker stats. So our broker stats and our info sparks. These are where we're pulling some current market data about what's going on in Oklahoma City. And then over here on yonder plain Jane Excel spreadsheet, we're going to dig into these ideas. All right, so from Fred and broker stats, we have discerned that in August of 1990, the prevailing interest rate was 9.24%, which was a steal compared to the 10.5% that was happening a year before. And the average home in Oklahoma City was $85,010. So if you factor in just principal and interest, because I didn't dig into the prevailing local property tax rate at the time, and I have no idea how to know what insurance rates were at the time, or if people even had insurance on average in 1990. I'm sure there's a way to figure it out, but beyond the scope of this video. So what was the resulting principal and interest from a 20% down loan on an $85,000 home at 9.24%? So your resulting principal and interest payment was $558.99. And so compare that to the current prevailing interest rate. We're trying to be as moderate and conservative as possible. 3.25% interest rate on a 20% down purchase of a $254,846 home. The resulting principal and interest here would be $887.29. So cool beans, right? Let's talk brass tacks. What does this mean? This means that our interest rate today is 35% of what it was in 1990. So 35%, the rate of 1990. So let's see what that's done to our average home. So our interest rate has gone into thirds, and our home has tripled. Well, that's interesting, isn't it? Our interest rate has cut into thirds, and our home has tripled. Well, that's interesting. And then our resulting principal and interest is not triple. It's 160%. So while homes have gotten more expensive on the dollar value, like the nominal price of the home. So the nominal price of the home today, the average home in Oklahoma, the city metropolitan area, is $254,000. Nominally, in name, that's quite a bit more expensive than the average home in August of 1990. However, in real terms, like what's the resulting principal and interest payment associated with that home? Well, thanks to an interest rate that's a third of what it was in Q3 of 1990, our resulting principal and interest is only 160% higher than what it was in 1990, but for a 300% more valuable home. And so the reason that we can consider this an effective hedge against inflation is that while your resulting principal and interest did go up, your home value outpaced that quite a bit. So in nominal terms, in name only, in that same period, the average went up 300%, while the payments associated with average did not keep pace with that. So the value outpaced the actual cost. And this is something tied to a phenomenon or a reality that I've been trying to drill into the heads of the buyers that I have the privilege of working with, is that to a seller, this is seller speak. Like the average seller in 1990 was receiving $85,000 for their home. The average seller today is receiving $254,846 for their home. But the average buyer is not paying $85,000 and $254,000 respectively. The average buyer is paying $558.99 a month, $887.29 a month. So actually, in resulting in just the brass tacks of what this home costs, ignoring taxes and insurance, the home has gotten substantially cheaper per value of the home, thanks to the interest rate. All right, let's jump back and debrief.
So why is this good news? Well, let me just tell you a little thing about what happens when you factor in inflation. So let's say you're that average bloke back in 1990 holding on to that $85,000 house. So the $85,000 house, if you're to sell it then and the buyer's going to come in, use a 20% down conventional loan at the prevailing interest rate, then the resulting payment is going to be what we talked about. It's going to be $558.99 per month on average for principal and interest. So the Gov is targeting an annual inflation rate of 2%. That's not happening because remember that year that they peed in the pool and like the pool overflowed, when they printed, it's digital mostly, $7 trillion, and then the pool overflowed, like every market of every asset and every commodity, like in furniture prices. And have you tried to buy a stove recently? And good night, the pool overflowed, but it wasn't pure water. But remember, just ignore the fact that they created like 40% of all currency that exists last year. The fact of the matter is, they say that the goal is to produce an annual 2% rate of inflation. So what happens to that buyer's principal and interest payment back in 1990 if you adjust it for inflation? Means in 1990 dollars, what was $558.99 a month, what is that today? The equivalent, today's equivalent of $1990, $558.99 in 1990 would be $1,032.78. Means if you adjust the monthly resulting payment of the median home or the average home in 1990 to today's dollars, we would be spending $1,032 a month to own the average home. But what did we say was the resulting principal and interest payment of the average home today? $887 a month. That's the whole idea, is that yes, values have gone up and up and up, but because of the underlying inflation that happens, means there's more dollars chasing goods and services, and goods and services become more expensive as a result or alongside that. It means that while the homes are more valuable, it takes less dollars every month to own the home because of other factors. Who controls those other factors? Very good point. Who decides that the 3.25% is a good interest rate? It's not good for investors. It's the government. So we're thankful that they are slogging away, creating affordable housing. And what you can see is, though the price of housing is substantially higher in nominal terms, on a practical month-to-month level, it has underpaced inflation. It is now more effective. But here's the magic to the 30-year mortgage. And this is why a home itself can be an inflation hedge, and a mortgage can be an inflation hedge. So if you own that house and you bought the average house back in 1990, today that home is worth substantially more, right? Like that average home, probably still average, you probably put some money into it along the way, but let's say you've totally renovated it. Let's say you've put into it what it was worth in 1990. So you're all in for $170,000. Well, good news, the market buoyed the value of your home, because that's what the market does when it's being inflated and stimulated, and when it's fiat, when its value is derived from what we're told its value is. So that's not a bad thing or good thing necessarily. Like the purpose of this is not to make statements about the morality or the goodness of inflation and fiat aspects of currency and things like that, but rather to illustrate to you that if you own the home, you're participating in this buoying and the fluidity of the value of assets relative to the currency. So now that home has gone up 300% in 19 years. So it's worth 3 times what it was when you bought it or whatever. But the buyer can come in and purchase it for relatively less money every month. So, but what happens if you would have had $85,000 in 1990 and stuck them under your mattress? You'd still have $85,000. So you would have the dollars, or you could have turned the dollars into an asset which buoys with the underlying inflation. and your $85,000 would be $85,000, or your $85,000 would be $256,000. Like, that's the basic effect of inflation on assets versus cash. Now, if you were to purchase that home using debt, now let's fast forward to today. So what would your payment be if you had a 30-year mortgage on that home in 1990? And if you hadn't paid in advance, you hadn't paid it off, you're still living in that home, and it's still your payment. It would be $558.99 a month. So you own that home for $558.99 a month. But what did we say was the present inflation adjusted value of your monthly payment? $1,000.32.78 a month. So you locked in 1990 dollar rates for your home, and even though the underlying value of your home has gone up and up and up, your dollar obligation to that debt stays the same. What happens if you hold on to it for another 10 years? Assuming the market cycles participate and the government continues to keep interest rates low. And those are the threads that we can continue to pull on to better understand how a home and a home mortgage can be effective hedges against inflation. So if people keep peeing in the pool and overflowing it, or if this or that happen, and homes continue to go up and up and up, wouldn't it be better to own assets like homes than be in cash? And wouldn't it be better to have a reasonable mortgage rate loan on that home that you can afford? All of this based in sound financial wisdom. Don't be chasing multi-million-dollar homes when you can afford a $500,000 home, but a home you can afford today with a mortgage that makes sense. Isn't that a better situation than being subject to, hey, I own in dollars, or hey, I'm betting all on this thing? No, we'd rather have some hedge against inflation that rises and buoys with the underlying currency value instead of being all in that currency. So, for more on this, I would highly recommend, as I have in my last few videos, Marin Katusa's book, The Rise of America. It's going to focus more on economics as a whole than on the housing market, but fundamental understanding to how we are right now, how we got here, and what does that mean for us in the future. And then also check out George Gammon's podcast, The Rebel Capitalist Show. Thanks for tuning in. If you're still with me, subscribe, and I will just be delighted every time that bell goes off. And then let me know what you'd like to see explored, and I'll get in, and get dirty. Or probably more nerdy. Thanks a lot. Have a wonderful day ahead.